source, purpose, destination. Records. If money comes into your account, you should know the source. If money leaves your account, you should know the purpose. If money moves somewhere else, you should know the destination. And if anyone asks about it later, you should have a record that does not depend on memory. Let me give you a simple picture of what this looks like. Imagine a retired couple. They are not wealthy, but they are careful. Social Security comes in once a month. A small pension comes in near the end of the month. They have one checking account they have used for years, one savings account, and a few automatic bills they set up long ago. 1 month, 3 normal things happen. A medical bill hits earlier than expected. An old subscription renews for another year. Their daughter asks for help with a home repair, and they send money quickly because they want to help. Then a check from selling an old car clears later than they thought it would. Nothing in that story is criminal. Nothing is strange by itself. But if nobody is reviewing the account, if nobody knows which money is for which purpose, and if nobody keeps the paperwork, normal money starts to create pressure. In this video, we are going through 5 bank account mistakes seniors should check first, and the simple way to fix each one before it costs you more. And before we start, I want to be clear about one thing. This is not about hiding money from a bank. It is not about avoiding rules. And it is not personal financial, legal, or tax advice. This is about making your money easier to monitor, easier to protect, and easier to explain. Because the safest money is not money you hide. It is money you can explain. Mistake number 1 is moving money because of fear or scam pressure. This is one of the most dangerous bank account mistakes because it can feel responsible in the moment. A message says there is a problem with your account. A caller says your money is not safe. An email says there has been suspicious activity. Someone tells you to move money now, before it is too late. And the mistake is not being concerned. Concern is normal. The mistake is letting fear choose the next move. If someone tells you to wire money quickly, withdraw cash quickly, buy gift cards, move money to a safe account, send crypto, or split transactions so they do not attract attention, stop. That is not a money plan. That is pressure. Real banks do not need you to panic. Real protection starts with verification. If a message says it is from your bank, do not call the number in the message. Do not click the link. Do not reply with account details. Use the number on the back of your card, the official website, or a branch you already know. And before any money moves, write down 4 things. Where is the money coming from? Why is it moving? Where is it going? What record will prove that later? That might sound simple, but simple is the point. Scammers want speed. Clean money needs clarity. If you slow the moment down, verify the contact, and write the purpose before moving money, you take away the scammer's biggest advantage. The fix is usually simpler than the mistake. Pause. Verify. Then move money only when the source, purpose, destination, and record make sense. Mistake number 2 is not watching fees, overdrafts, and autopay timing. This one does not feel dramatic. It does not feel like a scam. It does not feel like a big warning sign. It may look like a small monthly account fee. A subscription you forgot about. A bill that hits one day before Social Security arrives. A payment that used to be fine when you were working, but now lands at the wrong time. That is why this mistake is so easy to miss. After retirement, the account may be the same, but the rhythm of the money changes. Paychecks may stop. Social Security may arrive on a fixed schedule. Pension payments may arrive once a month. Interest may come in slowly. Medical bills may arrive unevenly. And old automatic payments keep running as if nothing changed. So a bank account that worked fine for years can start costing you money quietly. Maybe it is an overdraft fee. Maybe it is a non-sufficient funds fee. Maybe it is a monthly maintenance fee on an account that has a better low-fee option. Maybe it is an old membership, insurance draft, streaming service, software subscription, or donation that renews every month because nobody reviewed it. The mistake is not using autopay. Autopay can be useful. The mistake is letting autopay run without review after your income timing has changed. This matters especially when income is fixed. When you are still working, a small timing mistake may be annoying, but the next paycheck may cover it quickly. After retirement, the timing can be tighter. Social Security, pensions, retirement withdrawals, and interest may arrive on schedules you do not fully control. A bill that hits on the 2nd of the month may create a problem if the income arrives on the 3rd. A subscription that was harmless 10 years ago may now be one more charge in a month that is already tight. And the worst part is that many people do not see this as a bank mistake. They see it as just how the account works. But accounts can be changed. Due dates can often be adjusted. Some fees can be avoided. Some subscriptions can be canceled. Some alerts can be turned on. And some accounts have lower fee versions that people never ask about. Here's the simple fix. Once a month, review 3 lines. Fees, auto payments, income timing. Look at every fee. Ask whether it is necessary. Look at every automatic payment. Ask whether you still want it. Look at the dates money comes in and money goes out. Ask whether the timing creates avoidable stress. Then turn on 2 alerts if your bank offers them. A low balance alert and a transaction alert for larger withdrawals or payments. You do not need to check your account every hour, but you do need a rhythm that catches small leaks before they become habits. Because after 50, losing money is not always one big disaster. Sometimes it is 12 small charges a year that nobody questioned. Mistake number 3 is moving large money without source proof. This is where many careful people get nervous, and I want to say this calmly. A large deposit is not automatically a problem. A large check is not automatically a problem. A wire transfer is not automatically a problem. The problem begins when the money is legitimate, but the explanation is messy. That is an important distinction. You are not trying to prove that you are a financial expert. You are not trying to predict every question a bank might ask. You are not trying to create a legal file for every small transaction. You are simply trying to keep enough information so that a normal transaction stays easy to explain. Maybe you sold a home. Maybe you sold a car. Maybe you received an inheritance check. Maybe an insurance payment came in. Maybe a pension or Social Security lump sum arrived. Maybe a family member repaid you. Maybe you moved savings from one bank to another. Each of those can be normal. But if someone asks where the money came from, and the answer is only in your memory, you have made the money harder to explain. This is where cash, check, wire, and transfer are not all the same. Cash needs source proof. If you sold something for cash, keep the bill of sale, receipt, note, or any document that explains why you received it. A check needs payer proof. Keep a copy of the check if you can, the deposit receipt, and the document that explains the source. Settlement statement, executor letter, payer note, bill of sale, or account statement. A wire needs destination and purpose. Where did the money go? Who received it? Why was it sent? What confirmation did the bank give you? A transfer needs confirmation and account ownership clarity. Was it between your own accounts? Was it to a family member? Was it to a title company, broker, contractor, or medical provider? The amount matters less than the trail. Here is a useful test. If someone asked you about the transaction 6 months from now, could you answer without guessing? If your spouse asked, could you show the record? If your adult child had to help you organize documents, would they understand what happened? If your tax preparer asked where the money came from, would the answer be in your folder or only in your memory? That is the difference between money that is merely legal and money that is easy to explain. The fix is a source packet that does not need to be complicated. For any larger money event, keep 4 things together. 1. The document that shows where the money came from. 2. The deposit receipt or transfer confirmation. 3. A short note saying why the money moved. 4. The destination if the money left your account. That is it. Source, purpose, destination, records. You are not creating paperwork to impress anyone. you are creating a simple answer for your future self. Because 6 months from now, your tax preparer, banker, spouse, adult child, or estate paperwork may ask a very simple question. Where did this money come from? And the best answer is not a long story. The best answer is a clean record. Mistake number 4 is mixing family money with retirement money. Helping family is not the mistake. Many people over 50 help children, grandchildren, siblings, parents, or close relatives. They help with a down payment. They cover a medical bill. They send money during an emergency. They receive money from children. They deposit money for someone who cannot get to the bank. They let a trusted person help with the account. The mistake is moving family money in a way nobody can clearly explain later. Family money feels personal, so people often treat it casually. I know what it was for. My daughter knows what it was for. My son will remember. It was just temporary. We will sort it out later. But memory is not a record, and when money crosses between family members, unclear records can create problems even when everyone had good intentions. Was it a gift? Was it a loan? Was it reimbursement? Was it shared expense? Was it money you were holding for someone else? Was someone helping you pay bills? Was someone given access to your account for convenience? Or because you wanted them to manage money for you? Those are very different situations, and if they are not written down, confusion can cost money, time, and trust. It can delay a home purchase. It can confuse a tax preparer. It can create disagreement between siblings. It can make a surviving spouse or adult child wonder what happened. And in the worst cases, loose account access can expose an older adult to exploitation. The fix is not to stop helping family. The fix is to make family money clear. Use a family money note. Write the date, the amount, who gave the money, who received it, the purpose. Whether it is a gift, loan, reimbursement, shared expense, or something else. And who can verify it later. If the situation involves taxes, inheritance, a mortgage, legal ownership, or someone managing money for another person, talk with a qualified professional. But for everyday clarity, a short written note is already much better than memory. When family money moves, make the purpose visible. Because helping someone should not make your own retirement money harder to explain. Mistake number 5 is having no account protection system. This is the one that ties the other 4 together. The question is not only where your money sits, the question is, who notices when something unusual happens? If a scammer tries a fake transfer, who notices? If an old auto payment keeps charging you, who notices? If a large deposit arrives and the paperwork is missing, who notices? If family money starts moving in and out, who notices? If your health changes, your memory changes, or stress makes decisions harder, who is allowed to help? A bank account is not protected just because it has a password. Protection is a system. Start with alerts. Turn on alerts for low balances, large withdrawals, online transfers, debit card activity, and new payees if your bank offers them. Next, use a records folder. It can be paper, digital, or both. The format matters less than whether you can find things quickly. For larger money events, keep the source document, transfer confirmation, purpose note, and destination information in one place. Next, use purpose buckets. Not necessarily separate accounts for everything, just clear categories: daily spending, emergency money, large event money, family help, tax or records documents. When every dollar is in one mental pile, every decision feels harder. Finally, choose a trusted contact or trusted helper before you need one. This does not mean handing someone full control of your money. It means deciding who can help you notice a problem, read a statement, organize records, or contact the bank if illness, stress, or confusion shows up. The mistake is waiting until there's already a crisis. The fix is a simple monthly money desk review. Do not make this review complicated. If it takes 2 hours, most people will not do it again next month. Make it small enough to repeat. Look at the statement. Look at the fees. Look at the automatic payments. Look at anything unusual. Then ask one question. Is there any transaction here that my future self would not understand? If the answer is yes, write a note now. Future you will not remember every detail. Future you may be tired, stressed, sick, grieving, traveling, or helping family. The record you make today is a favor to the version of you who has to explain the money later. Once a month, check 4 things. Fees, auto payments, unusual transactions, documents for any large money event. That one routine can prevent a lot of silent account problems. Because the goal is not to become a banking expert. The goal is to make the account easier to protect before something goes wrong. So, let us bring the 5 mistakes together. Mistake 1. Moving money because of fear or scam pressure. The fix: stop, verify, and do not let urgency choose the transaction. Mistake 2. Not watching fees, overdrafts, and autopay timing. The fix: review fees, auto payments, and income timing every month. Mistake 3. Moving large money without source proof. The fix: keep a source packet with the document, confirmation, purpose, and destination. Mistake 4. Mixing family money with retirement money. The fix: write down who, amount, date, purpose, and whether it is a gift, loan, reimbursement, or shared expense. Mistake 5. Having no account protection system. The fix: alerts, records folder, purpose buckets, trusted help, and a monthly review. Notice what all 5 have in common. They're not about being clever. They're not about hiding money. They're not about memorizing every banking rule. They're about making normal money easier to monitor, protect, and explain. And if one of these mistakes sounded familiar, do not treat that as a failure. Treat it as the easiest place to start. You do not have to fix every account, every document, and every family money question today. Start with one thing. Cancel one payment you no longer need. Turn on one alert. Put one large deposit record in a folder. Write one note about one family transfer. Call your bank and ask whether your account has a lower fee option. Small fixes matter because most account problems start small too. If you remember only one line from this video, make it this: the safest money is not money you hide. It is money you can explain. Where did it come from? Why did it move? Where did it go? What record proves it? And did you review the account before a small mistake repeated again? That is the money desk system. Source, purpose, destination, records, review. That is how you make your money easy to explain. In the next video, we are going one step deeper. We will look at what banks actually look for when seniors move money, what kinds of questions are normal, and how to stay calm when a transaction gets reviewed. Until then, do not move money because of fear. Do not let small fees run forever. And do not rely on memory when a simple record would protect you better. I will see you in the next one.